Selling stocks isn't about candlestick charts or moving averages. This isn't a day trading video. Instead, I'll share the exact steps I take to decide when to sell my long-term investments by evaluating the actual business. First, I want to mention a selling strategy that most home investors use, but I think it's a terrible idea, and I think you will too. Let's say you love apples. You eat about 100 a year, so you decide, why not invest in an apple tree? You spend weeks finding the perfect variety, and you buy a young apple tree for just $30. The tree turns out to be even better than expected. And in year one, you hit your 100 apple target. Brilliant. So you cut the tree down. You got the exact harvest you wanted, right? So you get rid of that tree, and then you start looking for another apple tree to produce next year's apples. Nobody would do that, would they? Because we all know that tree will produce hundreds more apples as it matures. But home investors, they do this all the time with their stocks. They buy a stock at $30 and they say, if it hits $40, I'll sell and lock in my gain. But they usually make that decision completely detached from the actual business. It's a self-imposed random limit. And it's perfectly possible, as that business matures and grows, it could have reached $400 a share, not $40. We shouldn't cap our harvest at 100 apples. And we should only get rid of the tree when it shows signs of decline, rotting the bark, diseased leaves, poor quality apples. That's what this video will do. Show the signs that a once good investment is no longer a good investment, because that's when you should sell. That's what I do anyway. Different investors, they have different strategies. I'm not saying they don't work, but this is mine. There's one exception to that rule though, because sometimes it does make sense to cut down a perfectly good apple tree, but I'll come to that at the end of the video. Before we get into the nitty-gritty of the financial metrics, I want to start with a sign that you can actually spot before it even shows in the financials. To do that, let's go back to 2015 and look at a small video game developer called CD Projekt, at the time valued around $400 million. In May 2015, this small developer released The Witcher 3. It got widespread critical acclaim and went on to become the 10th best-selling video game of the decade. Over the next 5 years, CD Projekt's share price soared over 1,700%, fueled by that product's runaway success. Fast forward to December 2020, and CD Projekt released their highly ambitious Cyberpunk game. The hype was off the charts. Keanu Reeves even played a starring role. But then players discovered it was riddled with bugs and glitches so bad, it was basically unplayable. Reviewers hammered it, gamers ridiculed it, and refunds piled up, and the stock crashed 80% over the following 2 years. But that's not the end of the story. As the stock crashed, CD Projekt were releasing updates to fix the game. And by early 2022, the developers had ironed out the bugs and patched every major issue. They even added extra stories and content. Cyberpunk was quietly winning back its fans. And over the last 3 years, the share price has risen 231%. Here's my point. If you'd played The Witcher 3 here in mid-2015, you'd know that that apple tree was going to bear fruit for years, because the product was so obviously good. Likewise, if you'd been following Cyberpunk up to its release in December 2020, you'd have known it was probably time to sell. It was pretty strongly suspected that CD Projekt had been overly ambitious before the game was even released, long before the financials showed it, and certainly way before the full 80% drop, which took 2 years. And if you had played the game after the updates here, you'd have known the product was actually really good now. So you'd have known sales were probably going to increase way before it came out in the financial reports. This is the perfect example that the product or service is king. Once that product starts to get worse, once those apples start to taste bad, that's a problem. And it's a big indicator to sell. If you're a customer of the business, you can spot that before the wider market has time to clock on. Back in January, I sold all my Adobe stock. That business has good sales growth. It's really financially strong. On paper, it's brilliant. The main reason I sold is I've used their products for almost 20 years, but I don't think Adobe are keeping up with advancements in AI. There's so many features in their products which AI could and should do. The subsequent releases of things like Google's Veo 3 in May have only solidified that idea for me. Adobe's dropped 15% since I sold, and I won't look back at reinvesting in them until I use their products and I think, wow, this is amazing. That is something no financial report will ever tell you. But That doesn't mean you shouldn't look at financial metrics. They are, of course, still very, very important. It's what I do a lot on this channel. And many of you use my free stock screener where I focus on these two strategies, the lower and balanced risk ones, which have exact financial metrics that I think identify great buying opportunities. But we can also use financial metrics as indicators for when to sell. Let me show you the warning signs I look for, as well as the one that made up my mind on that Adobe sale. And then I'll finish with one of the very best reasons to sell, which no one really talks about. The first issue is financial instability. A business can go from financially stable to unstable a lot quicker than you might think, primarily because a business's assets can be reevaluated and then potentially downgraded in value, which can drastically alter the company's debt position. Pretty much overnight, a company can go from having more net asset value than debt, which is a good thing, to having more debt than net assets, which is a bad thing. This research by JAG Capital Management split stocks into those with high debt and those with low debt. Those in the highest debt banding achieved just 7.5% returns on average, whilst those with the lowest debt achieved 17.1% returns. Debt kills businesses. So if I saw the debt to equity ratio for one of my investments go above 1, that would be a big red flag. Likewise, this research from S&P Global clearly showed that the higher a company's cash flow yield, the better it performs. Positive cash flow is the lifeblood of a business. Without it, they're going to need outside funds in order to grow. And that's either going to come from more debt or it's going to come from investment funding. That's not ideal. Seeing one of my investments have a negative cash flow in a quarterly report wouldn't be good. But if that negative cash flow stretched to the full annual report, that would be another big red flag. Now, a financially stable company quickly becoming unstable, it does happen, but it's kind of rare. This next sign, however, isn't rare, because sooner or later, every business stops growing, which means you need to spot the indications that that growth is going to tail off. And I focus on sales growth much more than earnings growth. That's different to what a lot of people do, because earnings, profit, after all, that's the whole point of a business. I totally get that. But history tells us that sales, they usually provide a truer picture of a company's growth. Let me explain why, because the differences, they are really important. Firstly, earnings per share, they can be misleading, not in a fraudulent way or anything like that, although that can happen, but that's not what I mean. A very good example is share buybacks, perfectly legitimate. A share buyback program is basically when a company buys back its own shares. And as they're repurchasing those shares, that reduces the number of shares outstanding, which means that the earnings per share increase. But the profits haven't really changed. It's just the same amount of profit split between fewer shares. Apple's massive buyback program ensured its EPS grew almost every year for the last decade. And that's been great for shareholders. However, it's concealed the full story because Apple's revenue from 2022 to 23 actually decreased, but their earnings per share went up. Sales were dropping way before the EPS dropped, but eventually it did. Between 2023 and 24, and since then, Apple is down 13%. But you can't really inflate your total revenue figures. So they're a really true picture of whether the business is selling more stuff now than it used to. My second reason for not focusing too heavily on earnings growth is that short-term reductions to profit can actually totally make strategic sense. Meta intentionally slashed their profit potential in 2022 and 23 so they could pour cash investment into VR, AR, and AI development. Earnings dipped, and granted, in the short term, the market didn't like it. But their sales never slowed. In the past 5 years, Meta has grown its revenue at an average annual rate of 18.4%. The stock has gained 650% since its 2022 low, and Meta is back to having one of the largest profit margins of any major company. And it's becoming very clear that Zuckerberg's move to invest heavily in AR, VR, and AI 3 years ago was a very good one for the long-term health of the business. It totally justified the short-term earnings drop, which is why my red flags for growth are mainly related to revenue rather than earnings. A total 5-year sales growth under 50%, and a trailing 12-month sales growth slipping into single digits, or even worse, a decrease. Either of those would be worrying. There is an earnings metric that I do pay attention though, the expected EPS growth. It's an estimate, and estimates are actually usually wrong. But I want to see an EPS growth figure of at least 10% per year for the next 5 years. I wouldn't immediately sell if it went down to like 8-9%, but it would prompt me to investigate why analysts are suddenly so pessimistic about the growth of that company. They may have spotted something that you've missed. This next sign is the one that's actually most likely to happen to your stocks: overvaluation. It's probably quite clear by now that I focus pretty heavily on whether a company is still in a good position to grow. And when they're not, it's probably time to sell. But even a high growth business can see slow or even declining share price growth if it becomes overvalued. And we can't just use static valuation metrics like the PE ratio in order to value a business, because they don't really incorporate growth. What I tend to prefer instead, and what provided me with the final signal I needed to sell my Adobe stock back in January, is the price earnings to growth ratio, or the PEG. It takes the PE ratio and then divides it by the expected annual growth in earnings. I like to use the average expected EPS growth for the next 5 years. Below 1 is undervalued. In these cases, simply hitting the earnings target should boost the price. Between 1 and 2 is generally a fair valuation, above 2 is expensive, and above 3 is overvalued. If the share price got so overhyped that it caused the PEG to go to some ridiculous level like 5 or above, sometimes even double digits, that in itself could be a strong enough signal to sell. Because the business would have to achieve like quadruple the expected earnings for multiple years in order to meet those kind of valuations. But it's more likely your stock will stray into these kind of regions, 2.5 and into 3. That is not an instant indication to sell. Microsoft is sitting at 2.55 right now, and there is no way I'm selling that stock. But those levels of valuation, they would prompt questions. Because those businesses, they're going to have to perform really, really well in order to merit that high valuation. And this was the precise question nagging me about Adobe. Let me show you what Adobe looked like when I sold. Using the metrics that we talked about in this video, this is exactly how I made my decision to sell. The debt to equity was 0.42 and it was very cash flow positive, so no problem with either of those. The 5-year sales growth was 94%, which is great, no problem there. Likewise, the 1-year sales growth was 10.6, which is solid, not amazing, but not a problem either. However, the PEG ratio was 3.02. Not enough to warrant a sell just by itself, but combined with the nagging feeling that the product just wasn't keeping up, it was high enough to make that decision to sell. You can see from that example that whilst we can set pretty exact thresholds for when we might consider selling, the exact moment to sell really comes down to a bit of a judgment call. But there's one more super important element to the decision of selling that I haven't mentioned yet. In fact, it very rarely gets talked about in the when to sell conversation, but it was a third factor in my decision to sell that Adobe stock. Because I didn't just sell Adobe and hold that cash. I used it to buy Uber shares because I thought Uber was a better investment. And that's something that doesn't really get mentioned. Buying and selling are very much connected, because in a way, one of the best times to sell a stock is actually just when a better opportunity comes along. If I found an incredible investment this week, then I would probably sell one of my other positions in order to buy it. I thought Adobe was the weakest stock in my portfolio, but I also wanted to buy Uber. So that sale, it made sense. And even if Adobe goes up next year, it'll still make sense as long as Uber goes up more. That's what all these metrics I've talked about in this video are also useful for, spotting the weakest link. Not necessarily because the share price is just about to plummet, but because you just found another investment that's better. And whilst Adobe's down about 15%, Uber's up about 30%, so I'm happy I made that swap. And if you're interested about the exact strategy I used to find those better investments, then watch this video next, where I show you the exact steps and parameters that I use to find them.